Are Fed rate cuts the way to go here? Why not have a big fiscal stimulus package? What do you make of this big announcement today, Greg?
Well, it can hurt. Not at the margin, it will help, but it's not going to be the solution for two reasons. Number one, this is primarily a supply-side shock. As Jay Powell said, the Fed can't fix a supply-side shock. There's a ton of activity we're going to lose because people just don't want to leave their homes or, travel. Fed can't fix that. But beyond that, Kelly, there's the fact that we're in this brave new world where central banks, they just don't have much ammo. I mean, the European Central Bank and the Bank of Japan, they're below zero. There's nothing really that they can effectively do. The Fed will soon be out of ammo. And frankly, with the long bond at 1%, honestly, with taking it to zero, help much.
Right.
These are the conditions that are tailor-made for fiscal policy. Fiscal policy becomes more powerful at moments like this.
All right, we'll come back to this point. Steve, before we do, though, now that rates are basically, the overnight rate is set at about 1%, it is a range, but that means there's only 4 rate cuts left, right? I mean, before we get to zero. That's not a lot.
4 quarters or 250s.
That's right.
Or a 75 and a 25.
And what are people, so this is really important to explain the market's reaction here. If the Fed wants to come out and with this shock and awe, like, hey, we're getting ahead of this and doing something extraordinary, the market was already pricing in about 75 basis points of rate cuts by the meeting in March in 2 weeks. So they haven't gone all the way there. Do they have to do more at that meeting now?
They might have to do more. I believe if you listen to Fed Chair Jay Powell carefully, there's an invitation to the fiscal side to step in and help them out. I think Greg is right. Although I would push back just a little bit on Greg. He is absolutely correct. There's a supply side problem now, but a supply side could leading to a potential demand side problem, which is people don't leave their houses to go to work or don't have income. They may not be able to affect the demand they normally would. So in that sense, that's another sort of justification for a rate cut that I think everybody would agree is not the most effective tool, but it's perhaps one tool that needs to be done here en route to bigger and better things.
And so, Art, let me bring you in as well on this market reaction. The Dow's down about 500 points right now. Why do you, very simply put, why do you think that is? I mean, is it what the president and everybody's been saying, that they just didn't cut enough if they were going to do something that would have really shocked the market, right? You have to at least do more than what's priced in, right?
It's hard to disaggregate what the president's been saying about monetary policy for a while. He kind of treats Jay Powell like Veruca Salt treats her father and has been asking for rate cuts for a long period of time, agnostic of what's going on in the economy. So the fact that it's coupled with an epidemic right now probably is just coincidental. Well, I would tell you this, though, and I think Steve brought this up a couple times earlier today, this was pre-announced. We got this announcement on Friday, so half of Friday's turnaround. We cut our losses in half was part of that, and a good chunk of Monday's reaction was a part of this being priced in. So the shock and awe was diminished by the fact that this was a pre-announced cut.
So if part of the reason why the Fed cut rates is, and this is such a great to loosen financial conditions that had tightened, well, now they're tightening up again. So what, again, if we're to follow this line of thought, putting aside the question of whether this is really the right way to respond, if you're the Fed, what do you think they're likely to do given this market reaction now?
Well, I think the Fed has done the right thing by saying we can't do this alone. We need fiscal policy. I think Greg is exactly correct. There's a whole host of things the federal government can do right now to make sure that small and medium businesses that might be impaired for a short period of time because of an economic slowdown caused by this epidemic get put in place. And that needs to happen rapidly, on top of making sure we're funding our healthcare infrastructure and giving money to the CDC. All those things are more important than monetary policy right now.
Greg, what about the people who say, well, but we're already running a deficit and, will that, what can they really do? And anytime I've brought up this point, people say, well, Congress would never pass it. I have a hard time believing Congress wouldn't pass effectively, $1,000 checks to American families.
Look, you hear this all the time. Like after 9/11, you heard that in the end we did $40 billion in a matter of days. After Katrina, we eventually did $100 billion. We're talking right now $7-8 billion. That is peanuts. We have both the need and the ability to do way more than that. And also, we can target this really well. Elizabeth Warren yesterday had a really good idea. She pointed out there's millions of service sector workers out there who don't get paid sick leave. They're going to go to work even if they're sick, and they're handling our food and they're cleaning our beds. They can't keep their kids home from school because they can't look after them. Give those people emergency sick leave. That puts money, spending power in their hands, and it keeps them from going to school, going to work and spreading the disease. So fiscal power has both the ability to act where monetary policy is out of ammo, and it has the ability to be targeted in a way that monetary policy cannot. In my view, that will have significantly more confidence building and real world benefits than anything that can be done on the monetary side.
Rick Santelli, let me bring you in on the back of that. And please remind us again of what we're talking about in terms of levels in the 10-year. Rick, it looked like we fell to a new record low below 1.03% after the rate cut. I don't think that's what the Fed wanted. ironically, wouldn't they want the 10-year to go up in a sign of a better economy?
I can't tell you what they want, Kelly, because their actions don't make any sense to me. I'm not going to be an apologista for the Federal Reserve. I think what they did was an absolute waste. We have 1 to 125 left, very few bullets. I heard one of the guests say, well, it can't hurt. It most certainly can hurt. Negative rates. Every time we waste one of these, we're going to get to a point, viewers, listeners, I'll tell you the facts. Once it gets so close to zero and we really have something economically based to worry about, negative rates, there's no way they're not going to go there, no matter what they say, and they always hedge their bets. So can it hurt? It absolutely can hurt. And the other thing I have a real issue with, Kelly, is all the ifs. If this happens, if that happens, you know, when does government, first of all, become the only answer to every question? I'll tell you where, in Europe and points outside the U.S., which is why many of our ancestors came here. And at the end of the day, there's boatloads of agencies throughout the federal and local and municipal levels that were, according to our tax dollars spent, set up to deal with these things. So we're going to start passing out money before anybody makes requests. How many cases are here again? None of this makes any sense to me on any level. And as far as long-term rates, yes, how could they not go down? The whole world's a bit panicked. Other central banks are doing what the president wants, and not because it has worked, because they just can't think of anything else to do.
Always eloquent in moments like this, Rick. We appreciate it. Barry Glassman, let me turn to you. For those who are watching and going, you know, kind of to Rick's point, well, what am I supposed to do for yield? You know, I had someone email me earlier today and say, I have a 90-year-old who depends on CDs for her income. What am I supposed to tell her now?
Yeah, and that's the issue. When you ask most people what's going on in the market today, they talk about the stock market. Stock market soared this morning after the Fed made their announcement. And then you wrote your piece, well, it's not shock and it wasn't odd, so the market went down. And that's what they're talking about. But the problem is that's either temporary or it's a capital loss that's not yet realized. The bigger challenge here is safe yield for conservative investors and retirees. And I agree with Rick in that all of this, that we're putting our hopes on saving the U.S. economy based on lower interest rates, at least so far. And that's on the backs of retirees and conservative investors. The stock market is down about 6% or so. The S&P is down 6.5% or so year to date. The yield on 2-month treasuries is down by 44%.
Right.
So if you had CDs or money market and did the right thing, your income is plummeting right now, and it's all on the backs of retirees and conservative investors.